Good evening, and I'm just getting started here, going live here on YouTube. We are 1 minute away from officially getting started. So, sorry, multitasking here. We're about a minute away from officially getting started. I just come on to make sure everything's working. So, if let's see if the sound for starters is working. Can I see there's a few of you in already. Um, can I just get a check how the sound is just while we're getting started? It can just make sure the sound is working for you. If you could post a comment, that would be great, and just say yes or no. You won't know if it's not. Oh, great. Okay, loud and clear. I think there's a slight delay. By the time you post on the YouTube channel, then it comes through because I use a hub to broadcast through. So I think when I ask a question, it takes about 10 or 20 seconds by looks of things for people to respond. It's not. It's just that delay going through the software. So that's good. Nice to see you, Michael. Hi, JP, Atard. Bitcoin Bear. Oh, nice. That's an interesting one. Marco, Farouk, just to name a few there. So I was funny. I was sat at my desk here today. We've got this on. Let's put this onto the Nasdaq. I was sat at my desk here this afternoon, and I was thinking I've been meaning to do a live broadcast on YouTube for a while, and I know when I did the last one, I said, "Oh yeah, I'll do one in about a month or so's time," and it's probably a bit more than that. So I thought I've got a clear evening here. I'll come on. We'll have a chat. Well, it's quite interesting timing actually, because literally in this past hour, uh, we've um, we've heard a couple of Fed speakers just saying, "Oh, we're okay with maybe we should pause." Basically, in a nutshell, there. So a couple of Feds, two different ones within 10 minutes of each other, have said that. So you do sort of think, okay, that was two of them, and then there was another one speaking, although she didn't refer to anything. So there's two Fed speakers. I'm just doing some admin here, make sure that he's all right. Yeah, he's good. My trading room is doing a session live at the moment. One of my traders is doing a session there, just making sure that his software is all working. So yeah, the two of them have come out within 10 minutes of each other and said, maybe a pause is indeed warranted, because we've seen the market is just trying to fathom out whether the Fed is going to pause in June or is going to hike. And literally a week ago, the odds favored a pause. Literally this afternoon, the probabilities were sitting at a 70% probability that there's a hike. As of the last half an hour, I'll show you the data here. The pricing has gone back to just a 30% probability of a hike. Hopefully you can see this, and a 70% probability of a pause. And that's all just come out from those couple of Fed speakers just talking here in this last half hour. So it's actually good timing me doing this session here tonight, because I didn't know obviously earlier on that was what's going to happen, because that's where we're at the moment, isn't it? As far as, and it's not just the US, but everywhere around the world, all the central banks around the world are all generally trying to say the same thing. Of course, trying to get inflation back down to 2%. Obviously, the driver of the global economy, or one of them, the US, and everyone's looking out to the US. And so we know that jobs and jobs numbers are important, and inflation inflation data releases are important as well. Now, we just had a hotter inflation print just last week on the PCE number. This week we've got non-farm payrolls coming on Friday. So and we've just had quite a hot jobs number of the JOLTS jobs openings just this afternoon. So that sent the markets down, because the markets, even though that's a positive, The markets at the moment don't want interest rate hikes. So it's trying to find this balance as far as the data is concerned. Economic data releases coming in too negative is going to send stocks down, but too positive can send stocks down as well, because if it's too positive, then the Fed are definitely going to be hiking and hiking further than the market wants them to hike. That affects obviously the borrowing costs of companies as well, and ultimately affects their bottom line, their margins. So it's that balancing act that I guess the market is looking for. So not too hot a data report, but not too weak either. So, and to hear a couple of Fed speakers say, actually, we're okay with literally only 2 weeks out saying we think that we should pause, has just given, just having a look here at the NASDAQ, just given the stocks a little bit of respite. They were selling off today on the back of that hot JOLTS jobs numbers, and they've just put in a little bounce. It may not last, but certainly, certainly by the time we get to Friday's jobs data, so it may not last very long if we get a hot non-farm payrolls coming on Friday. But still interesting stuff anyway. So that's where we are. So I've got the NASDAQ up here. And as most of you know, the NASDAQ has been ripping higher. It's up, what, 30%? It's up this year. The S&P is not doing bad. It's up about 9% on the year. But way behind the tech-heavy NASDAQ, the AI-heavy tech companies there who are massively benefiting from the artificial intelligence revolution, so to speak, which is really hotting up at the moment. And that's why the NASDAQ is being powered ahead by some of those big stocks, Microsoft, obviously, NVIDIA, and some of those companies. So the NASDAQ's a big beneficiary there. S&P and the Dow, certainly the Dow much less so. S&P's doing okay. Bearing in mind, when you think about it, the S&P's historical performance, annual performance, sits around about, historically, over the last 150 years, is an average of long-term performance is an average of about 7% per year. We've been in recent years, when we've been treated to some, certainly some outperformance. So it's on 9% for the year. If we go and have a look at the S&P here, which is the bigger market, if you will, it's got 500 stocks within it, but not quite. If you zoom in slightly, as we can see here, it's off its lows on the day, not far away from, obviously it made new highs yesterday, but nothing like what the NASDAQ has been doing for the year. So what I still find interesting with regards to the stock markets is that from a probability perspective, we're in the third year of the presidential election cycle, which normally tends to be historically a positive. We've come on the back of a negative year last year, a decently negative year last year, just off of 20%, the S&P. And then the first month of this year, January, put in a greater than 5% gain. And again, historically, after a down year, the year before, if you have a January that does a greater than 5% gain, then that has always resulted in a positive year for the S&P, at the end of the year. Also, the first quarter of the year, if the first quarter of the year is greater than 7%, then again, historically, without fail, there's always been a positive to the end of the year. Sorry, that's 7% gain for the first quarter, again, following a negative year the previous year. So there's some statistics, and they are just statistics, and statistics are always there to be broken. Probabilities are always there to be broken, but there are some probabilities on the side of the stock market's actually holding up this year. From a sentiment perspective, we've got a lot of bearishness out there. We've got historical high number of net short positions in retail traders in the futures market. So retail traders who are trading S&P E-minis, we've got a historically high number of net shorts. So again, where would you rather be? We're all retail traders, even though I'm a professional money manager. I'm still effectively like a retail trader as well. I still trade for my own accounts as well. And so, but when we're looking at the collective retail, then traders out there, then on average, they don't have the best of track records, always, speculators especially. And so when they're all en masse doing one thing, I have to be looking at the other direction. So if they're all en masse shorting the market, got to be looking at the long side. Plus, we've got these probabilities. So that's fascinating as well. But then to top that off, we've got, as many of you know, we've got a exceptionally large number of hedge funds are holding net short positions as well. Overall, they are collectively net short and to a sizable amount, but they have been net short for quite some time because they can carry their shorts and hold on to them. But they've been short for quite a long time. This is on the S&P E-mini. So either the S&P E-mini is going to, I mean, it has been coming up, but it needs to come up in an even more forceful manner. And if that happens, that could, of course, help create a short covering rally. So either we're going to see that, or they're right, of course, and the markets are about to fall away. Because what I find is fascinating at the moment is that we've got essentially bearish sentiment, which in a market is fine if we've got bearish sentiment in a falling market, but we've got bearish sentiment in a rising market. And normally that adds to the wall of worry. That's a good, healthy thing. And it means that there's more fuel to add to the market. If you've got a lot of people that are short out there, then at some point they may well throw in the towel, close their short positions, which means that they're going to be buying, essentially, buying to cover, and potentially even going long as well. So from a sentiment perspective, it's fascinating there as well. However, then we've got the macro backdrop, and whereby we have got this situation globally where central banks are trying to engineer a slowing of their economies in order to bring inflation down. So they want to slow those economies down. They don't all want to push their economies into a hard landing type recession. They want a soft landing type recession. So they're trying to engineer a soft landing and some form of deceleration in their economies to help bring inflation down as well. So we know that we have the backdrop of certainly the central banks are trying to choke their economies to an extent to at least slow them down to bring that inflation down. So we know that's coming, and so we've got this macro backdrop where everybody's going to feel the squeeze from rising interest rates. Companies who borrow money as well, and they're going to feel the squeeze from higher interest rates. So it spreads everywhere, as we know, and we've seen that with the little mini banking crises that we've seen in the last couple of months or so out there in the States. So shouldn't you be shorting? That's the next question. Shouldn't we be shorting? Because from a macro perspective, we know what the central banks are trying to engineer and a slowing of the economies. So, and we've already got some parts of the economies which are starting to stall. We're seeing that in some of the global manufacturing PMIs. Figures. So we're seeing a contraction in manufacturing. We've just seen China's PMIs came out overnight, and they were less than were forecasted. So we have got this sort of growth, non-growth parts of many economies. The US manufacturing certainly slowed right down, but then the service sector is doing okay, and the jobs market is still very tight. So I find it fascinating. How's it all going to play out? Well, only time will tell us, won't it? But but I think the main thing for me is that when something's too obvious, if everybody, so to speak, if the masses are doing one thing, I'll normally be looking the other way. From a macro perspective, it doesn't make sense to think that the S&P, let's say rallies another 10% from here. I can't see how that could happen. But maybe it doesn't. But maybe it goes up 5% even. Maybe it doesn't even do that. But so from a macro perspective, I don't know what's going to need to happen in order for the stock markets to continue going up. But certainly they don't normally go down when so many people are short. So that's the dilemma right now, isn't it? Hi, Harry. so we only time will tell, as I keep saying. Time will tell where these markets are going to go. So I've got like I said, the S&P up here. I think the S&P. I've got some lines on my chart here. I've got a channel here. I've got this horizontal level across my chart here, which we just keep. Well, we've broken out this lovely horizontal level coming all the way back through. Oops, time after time after time after time after time, which we have broken out of. We are above. So that's a bit of a line in the sand there at the moment for the S&P, which is around about 41, 4140 is where my line is, but it's a zone. Generally speaking, it's a zone. So 4140 zone for that line in the sand. So yeah, it's I guess if we get materially back down through, let's call it, make it easy, 4100, then we have to then ask questions as to whether the S&P is actually going to do a retracement back to this lower trend line here across the lows from October of last year to what's that, March, the March lows here. So if it does get below there, if not, then we're above the breakout zone of this entire horizontal level of price action. So exactly, Harry. Yes, I'll read that out. And the reason I read out your comments is because anyone who's watching the recording, because a lot of people watch this as a recording, don't get to understand what I'm saying yes to. So yeah, Harry's saying markets can stay irrational longer than most people can stay solvent is the line, and you're absolutely right. And so yeah, I'll be interested to see what they do this year. I'm not saying they won't come down just because loads of people are short, because they still can, but so often when you do see extremes like that, something else happens. Anyway, so I guess that makes it a little bit easier there. Just to, if I zoom back in a little bit and say, well, all the time the S&P is above that, we'll call it 41, just a bit above 4100, 4120, let's call it. If it stays above that 4120 zone, then it's above this sort of breakout area it's broken out of, and it kept on bumping its head against it all year, really, from back in February here, and then came back up in April, and then throughout April and May, just been bumping its head along that zone. Then it has broken up. So I guess that's the line in the sand. If we get materially below 4120 or 4100, then yeah, the odds favor a retracement, and so then we can start looking at other sort of levels. Whether I've just put a trend line on here because markets do retrace to things like trend lines, and as well as historical lows and highs as well. So an interesting chart, that one, for the S&P. The Nasdaq, like I said, is beating its own drum at the moment, and so if we zoom in a little bit, there's a funny old candlestick formation building here where we've had a spinning top on Monday. Bearing in mind, Monday was a bank holiday, so it was only a half day's trading in the cash markets. Very low range day, but it was a spinning top, then a doji, possibly a hanging man, maybe today if it bounces a little bit more. So certainly a indecision zone up here at the moment. And you would argue that the Nasdaq's had a great run, and could it not be overdue a pullback? If I put this into a weekly time frame, what a great run it's had. Could it be due a pullback? Yeah, but even if it does a pullback, it doesn't exactly look like a bear market, does it? So at this stage, so we'll see. Oh, Harry, I'm so pleased that your memory serves you so well. Harry's just said that in the last live episode we talked about the Nasdaq and 15,000, uh, and it's knocking on its doors, on those doors. Yeah, we were. I can't remember how long ago the last episode was. I was certainly I would have been talking about these highs from August of last year, because I'm sure the last episode we weren't at these highs because it was only a couple of weeks ago. Hi, Davey. Nice to see you. And so, yeah, absolutely. We certainly breached that a couple of weeks back. But anyway, I do find the uh, the US stock indices fascinating, because there's so much data, especially in relation to sentiment there as well. Excuse me a moment. Carl is asking, do you use level two data and order book in your trading? No, because I don't sit there intraday trading, Carl. So not really necessary for swing trading. I didn't actually use it when I did use the day trader as well. I did used to tape read, so I did used to read the tape. Yeah. So I used to read the time and sales data, but that's not the same as level two. Um, so level two is where you can see the orders as they're being placed. I used to only read um, the time and sales data, which was, you know, actual trades that have been executed. So, and the reason that I've never really been that big on level two data is because orders get put up there and they get pulled. So just when you think, oh look, there's a certain order there, they do get pulled as well, as you know. So it's a highly manipulated art form in itself. If you're good at it, fine, but it is an art form by itself, because it can be manipulated there as well. So so no, I don't use it for that reason. That was the main reason. So I used to look at, yes, orders they've been executed, but not. I didn't used to bother looking at actual orders. Um, but again, a swing trading, then I don't need that anyway. So um, it's more for out and out sort of scalping and intraday trading. Um, yeah, let's go and have a look at some of the other markets whilst we're just getting warmed up here, and then we'll just have a Q&A and a bit of a chat. I think silver's fascinating today. I love seeing silver have a good run here, and gold. Um, Both of them have been the last couple of days or so for gold, but for silver, it's up since the end of last week and having a nice little bounce here. It had a stronger pullback than gold, so it's nice to see that one having a half decent little bounce there. As far as the dollar itself is concerned, the euros got, slam dunked a little bit here today, but again, on the back of these Fed speakers, we've just seen. If I take this to an hourly chart, you see the bounce that we've had after these couple of Fed speakers. I was saying earlier on, there's been a couple of Fed speakers just about in the last hour, less than that really, who have said that they'd be okay with a pause, basically, at the next Fed meeting. And the market was starting to price in more and more a Fed hike. And on the back of a couple of members there saying the same thing, saying, well, actually, we think maybe we should play a bit of a wait and see. Then what we've seen, if I show this again, the odds have massively dropped. This probability for a hike here is sitting now at 30%. This was at 70% just a few hours ago. So the probability for a hike at the upcoming Federal Reserve meet FOMC on the 14th of June, a few hours ago, it was at 70% and it's dropped massively. That's just on those two Fed speakers. So it just goes to show you the power that they can wield when they're doing Q&A, when they're doing presentations, how it can change markets around. So now we're back to a 70% probability of a pause. Now we've still got 2 weeks to go, and these probabilities will continue to to change around. And so if we have a look down here, you'll see what I mean. Yesterday, look, it was, so 1 day ago, 66% odds of a um, of a hike, and like I said earlier on today, it was up at 70% or more, maybe a bit more than 70. Um, and that's just a day ago, and here we are now at 30%. So quite a swing, and that, coming back to the likes of the euro dollar, is why we're seeing the euro bouncing and the pound especially having a great run here. The British pound is by far the big outperformer against the dollar. Carl, no problem. Against the dollar. So the pound over the last few days, what, 4 days now, has had 4 up days. Let's go and have a look at the Aussie dollar. Not quite the same. Let's have a look at the New Zealand dollar. Not quite the same. Let's have a look at the euro dollar. Not quite the same. So yes, they're bouncing a bit off of their lows, just on this news, but these other currencies have by far outperformed what cable has been doing. So it'll be interesting now, as I said earlier on, as we work our way towards the end of the week. We've got PMIs, manufacturing PMIs, out tomorrow afternoon, UK time, out of the US. We've had a hint out of Chicago today that their PMIs were a lot lower than was expected. And we did see a jump in the pound then, and it just gave it back 15 minutes later when the JOLTS jobs openings came out red hot. So if tomorrow's PMIs come out weaker, those manufacturing PMIs come out weaker, then again we could see the pound benefit from that and have a bit more of a bounce. However, we've got non-farm payrolls on Friday. We could then see that all get turned over again if we get a red hot jobs report there. So when I say red hot, maybe I'm exaggerating a little bit, but if we do get a strong jobs data, then so maybe another day tomorrow where cable can push up maybe a little bit more. But then it'll be interesting going into non-farms on Friday to see if they end up selling back off again afterwards. So bit of a bounce here, but the pound certainly doing good business at the moment, or decent enough business at the moment, relative to the likes of the euro, which is still, even though it's bouncing off its lows, is still very much on for a decent down day here. So overall, if I look at the euro, if we use the euro as the barometer, we're still massively up since those lows from last year. And so if I take this maybe out to a weekly chart to put it into some form of perspective, so from the lows that were made in September of last year, we're still comfortably up from those. But of course, it's a bit of a pullback that the euro's now had over the last 3.5 weeks. Of selling here. So, and it doesn't look at this stage like that is over. The only thing I've just started to note in recent days is that a lot of commentators now are talking about the March lows down here. Again, when too many people are saying the same thing, sometimes the market won't go there, or maybe it doesn't go straight there and it starts just chopping around for a while, or putting a bit of a bounce. But for now, from a macroeconomic perspective, I don't know what's going to get the euro back up to those highs. I was looking actually for the euro to get up to this 200-week moving average and go up and test that. It didn't manage to do it. and so we'll see. So we're trading now between the 200-week moving average and the 50-week moving average. We're trading between those. So my your guess is as good as mine at this stage. I must admit, with the weakness that we've had over the last few weeks and the repricing of the Fed funds rates for going into the end of the year, um, it looks at the moment that the dollar is on certainly on the going to continue to be on the front foot. Therefore, maybe the euro carries on. Maybe not right now. Just having a little bounce here this evening, and maybe it gets a bit of a bounce over the next day or whatever. But it looks at the moment like it's sell rallies. It looks to be the case. Michael, on the euro, can you show how your daily trend channel is drawn? Yes. Let's just zoom that out. Here's one I had prepared earlier. Oh, no, I haven't. It's not there. Okay, let me go into the object tree because I have got it. No, not there. I did have. Okay, yeah, that's probably it there. I've had so many trend lines. Okay. My trend channel was, if you mean this rising trend channel, that's how it was. I'd taken it off once the euro had broken that trend channel. I'd taken these lines off. That's why they were hidden. Because I didn't feel the need to have that channel on. But this is the rising channel. If that's the channel that you're referring to, Michael. Great stuff. Okay. So yeah, I've taken it off. I don't feel the need to have that on. So I'll just delete that for now. Don't need that now. Put that back onto the watch list. I do think one of the other markets that's been very interesting, I think the pound is interesting across the board at the moment. The pound against the crosses. I think that the New Zealand, Aussie New Zealand even, is an interesting market here. If I go take this out to the weekly time frame, and so if the Aussie New Zealand, this is on the weekly, lovely channel, as you can see here. So this is going back to 2020 on the weekly chart here for the Aussie New Zealand. I think it's a nice rising channel that it's in, testing the lows of the channel. But we've got this lovely steep trend line here across the highs. So if I just take this back down to a daily chart, you can see this trend line, and it's having a few attempts at breaking out of that trend line. So I'm looking for some Australian outperformance. Now, bear this in mind, folks. Next week we've got the Australia Central Bank, and I do think we've got some other medium tier news coming out, might be retail sales or something like that. But certainly we got the RBA next week, and Australia just had their CPI out today, and their inflation came out higher than was forecasted. So we may see a nod towards that from the RBA, because the markets were starting to think that the RBA was, done on its hiking cycle. You go and see inflation figures coming out like that, then they may have to reopen that. The New Zealand central bank have already said we're done. Inflation's falling, and we don't feel that we need to raise rates anymore. It'll just be interesting what goes on with the Australia there. So, and that could act as more of a tailwind to the Australian dollar. So, I think the Australian dollar is an interesting one as a breakout play of the trend line. So the declining trend line there, and still therefore trading within this. If I go to the weekly chart, trading within this channel, the rising channel. So what I would like to see is a breakout play, a breakout here of this declining trend line, and then to see a bit more strength from the Aussie New Zealand. So I think that's an interesting one to keep an eye on there at the moment. The Aussie New Zealand there. Um, Outside of that, those are probably, the dollar's always of interest, whether the dollar's against the pound or the euro. I'm always fascinated by the direct dollar plays, which is where I tend to do most of my trading if I'm not, outside of stock indices as well. Um, but I think the pound crosses as well is what I was going to say, because the pound's got this relative strength that we can see how well it's performing against a very strong dollar at the moment, and yet the pound's up for the last 4 traded sessions. So make sure that's not okay. Um, So have a look at the pound against some of the other major crosses as well, because the pound has certainly got relative outperformance at the moment, on at that repricing of where the Bank of England are going to be, because of the stickier inflation figures here. Inflation is coming down, but not quite at the pace that was the market and certainly the Bank of England would have liked. So. As a result of repricing of where the Bank of England may have to go, the pound is benefiting on that. Good evening, Enrico. Right, okay. I've talked a little bit about the markets there. We talked about them a lot at the beginning here. Let's just do a bit of have a little bit of a general chat and see what you guys, if there's any questions on anything, by all means, fire away. And this is where I don't know whether anyone's typing or not. So um, while I'm waiting, I'll just carry on talking. So I do think, as I said earlier on, that we're always in a fascinating place, but I do think it's fascinating at the moment. Even with the whole dollar story, that's becoming um, quite prominent, the dollar story at the moment, the US economy, which is essentially the dollar story, how resilient this US economy is doing, and where the Fed may have to go with rates, but we don't know. We still don't know, and that's why we're seeing a couple of Fed speakers saying maybe we should just pause this time. We can afford to pause. Let's get ourselves, 8 weeks worth of data, because we may start to see the effects of the tightening. They may still take a little bit of time to come through. And so that may well be, and so it could well be that um, we're gonna always see delayed effects of higher interest rates. So some of it takes time to filter into the economy. So and I think that's what some of the Fed speakers are saying. Paul Tudor Jones, one of the world's greatest investors and traders, um, was interviewed on CNBC, as some of you will know, a couple of weeks ago, and he said, "I think we're done. I don't think the Fed need to go any higher." So he set his stall out there a little bit, but then again, I don't think he was expecting a PCE number that came out stronger than was expected last week. So, but nevertheless, he still thinks that they're thereabouts done. So it might well be that there'll be some delayed effects of this rate hiking cycle, and which will start to come through as we get into the summer. Maybe. Um, I'm just trying to see what would move the dollar around. If we don't get those delayed effects, we will see the likes of the pound will still come down against the dollar. The euro will as well. But if we do start to see a softening of some of the data out of the US, then we could see a half decent dollar retracement. And when I'm talking about a dollar, I'm talking about euro dollar, a half decent bounce here in the euro dollar if that was to happen. But that's still going to take, week after week. There's not a lot of data coming out next week. I think we've got some services PMIs early next week, but not a lot next week. But this week, yes, tomorrow and Friday. So, but this is going to take the next several weeks to come before we really start to find out. But I think that the market really needs a muddle through economy, as I've been calling it. The US doesn't stutter too heavily, but it's not too hot either, and not growing too much. And so it needs a slightly weakening jobs numbers. See that CPI inflation still coming down, and just some of the other numbers just coming out maybe just a little bit weaker, but not too weak. And if we see that, that's the perfect recipe there for the Fed to hold, and then we might see stocks still rally, because the stock market doesn't want to see the economy contract too much. But if it's still red hot, then the stock market knows that means higher interest rates. So a muddle through environment of some data slightly better, some data not so good, muddling through might actually be the best condition for certainly to see stocks going higher, a generally risk-on environment. I appreciate that many of you might be wanting the stock markets to come down. That's natural as well. And so, as I've already said, when we come back to the S&P, if the S&P gets back down below, sort of, I've got 4140 on my chart here, so probably below 4120 on a closing basis, then yes, that could start getting interesting on the downside. You're looking for a summer rally, yeah. Oh, sorry, let's go. You were bullish on the euro. Trying to read your writing there, Davey. You were bullish on the euro. Do you still holding your longs? No, I'm out, Davey. I'm out of my longs. I'll talk to you about that in a minute. Michael's saying you're looking for a summer rally. Guess the S&P will want to get back to all-time highs at some point, whether this year or next year. I think that the S&P, to get to those all-time highs, so let's turn my lines off, and I take this back out to a weekly chart. To get back over to those all-time highs from back in January of last year, a muddle through an economy which is contracting a little bit, but people start to be less fearful that it's going to be a hard landing. That would probably bode well, okay, for stocks. But I don't know yet. I'm not 100% sure that we go up to make, and we do just go up to new highs. But I'm not a massive bear either. I might become more of a bear once all the bears stop being bears. You know what I mean? So if the sentiment changes and fewer people are bearish, then I might have a look at it if that's the case, if the technicals warrant it. But at the moment, yes, statistically, I'm going with those stats that I said at the beginning, that the probabilities side with the S&P having a positive year this year. And in fact, the probabilities suggest the S&P could be up 20% this year. So that's just the probabilities based on those historicals that I talked about earlier on. That on average, those years where the S&P's had a January greater than 5%, the first quarter greater than 7%, following a negative year the previous years. We've also had a Marty Swag Brett thrust just a couple of weeks ago. We don't have those that often, but again, they tend to suggest a 20% plus gains in the stock markets. So the probabilities suggest more to come for the S&P especially. But I'm not going to start making predictions about whether we go up to all-time highs. But I always take it one step at a time. But for now, yeah, I would like to see the stock markets higher based on those probabilities. But I'm very of the macro backdrop, and the macro backdrop is that yeah, they are trying to squeeze the economy a bit, and it will be interesting to see if they can balance it out or not. If they can't, and then all the data starts coming through really bad, then we'll probably see some sharper falls in the stock markets at some point anyway. But yeah, I'm at the moment, until proven otherwise, I'm still leaning towards the upside there, Michael. Davey, if I take us to the euro again here. Yeah, I can talk about it now. I'm out. But yes, I've been trading the euro on the long side since, well, really the day after we made the lows last year. So last year we made these lows. I was short with our traders in my trading community in this final leg down, and we exited. Our final exit was below 95.55, I think, was our final exit, right down there. And then literally 2 days later, no, it was on this reversal day. It might have even been, or either that or 2 days before. Anyway, it was down there at that point. 95.55 we exited on the final part of the trade. And then the day after this big reversal day, the day after that, we got long. So, and you'd think, oh, wow, what a great place to get long. Well, yeah, but it came up, and it came up so aggressively. We moved our stops up, fun enough, to break even. I said, oh, this is looking fine. Let's move our stops up, and then it did this deep retrace, just nicked us out, and then went up. Anyway, so I had a few attempts on the long side there, and ended up getting in. I can talk about this now. This was a non-farm payrolls day, this big up day here, and then we had a nice run up into about this zone up here somewhere up here. Yeah, into this zone up here. So didn't run it all the way. Had another trade through this last part of the leg here, and then coming into this year, I was long, Davey. Yeah. If I can, I was long right from here. I'd had a couple of attempts. I'd got long through this, then it pulled back, stopped me out. Got long into this, and then this big down day was the Credit Suisse affair, when Credit Suisse collapsed, and so so I'd had a couple of attempts anyway, got long over here. So I wanted to be long overall, and having a great run here. I was sitting in over £80,000 worth of open profits, and it didn't quite hit my target. My target was about 80, 90 pips higher than the highs that it made. Looked like it was going to go there to the target, but alas, it fizzled out and then just rolled over. So no, I'm not in them anymore, in answer to your question there. So I still I'm still keeping my eye out on it for the much bigger picture, the higher time frame stuff. But of course, at the moment, the pressure is to the downside. But I'm of course I'm always keeping an eye on these key markets that I do trade. Michael answered that. Nice 4-hour candle on the S&P. Okay. 4-hour candle S&P. I don't know. Maybe yours is slightly different to mine. Maybe let's have a look on the cash market. 4 hour. No, um, it's okay, but it's not locked in or done. It's not until that's closed. But yeah, okay. Kyle, been trading full time, 2.5 years, precipice of profitability. My tech can pull 4 to 9 R on a good quarter 1 strategy. Entry entry 5 minute mechanical, hour 12 hour, and 1 hour discretionary on the EU and G. Uh, do you think one setup is limiting me and should look to add another? Um, I'm trying to understand what you've actually just said. um, your tech can pull 4 to 9 R on a good quarter with one strategy. Entry off a 5 minute chart, mechanically 12-hour chart, and 1 hour discretionary. Yeah, I'm not really quite understanding, and I don't need to understand what your strategy is, Carl. If your strategy is profitable, then good. You're saying, do you think one setup is limiting you and should you add more? Well, no, not necessarily, because sometimes when you trade more setups, it can just get messier. So not necessarily. If that one strategy is profitable enough, then the answer, I wouldn't say you do necessarily need to. How long has that strategy been profitable for you in actual trading, not back tested? How long have you been trading that strategy, and how long has it been profitable? Davey, you always make money and lose small. Well, that's the idea with trading, isn't it? So, yeah, for me, it's especially now I've sort of evolved as a trader, as many of you know, because many of you know me, um, that I'm not trading the smaller time frame stuff. I'll still go down to the small time frames to look for entries, but everything is based on my bigger picture analysis. So, and that's what we do in the trading community. Funny enough, one of my traders who still comes into my trading room, but he's just signed a contract to manage over $100 million fund, and so I'm chuffed for him. And so he's just signed a contract, but he still comes in the trading room every week. And so, and that's what I always find fascinating, that you've got people like him, you know, very experienced now. I mentored him many years ago, personally mentored him, um, but highly experienced, comfortably profitable, has now just signed this contract with a fund, still comes in my trading room, because he gets it. He gets the power of what we do, the community, and then you get other people who come in and they're new and they last for a month. And you're like, I do have to laugh. So, but yeah, that's the power of the trading room. Is it's the ongoing stuff all of the time, the mindset side of things, which is the important stuff, and just the sense of belonging as well is an important thing. So, but yeah, it's good to have success stories like that. Not that everybody in my trading community wants to be go and manage money or have a fund, um, but um, but it's just in my mind because he's just signed the contract last week. Uh, did I? Oh, Davey, coming back to you. Did I lose on the euro with my longs? I gave back the majority of the profits. Yes. So I think no, I didn't lose on the longs, but I gave back a large majority of the profit. So I think when it comes to um, when you're trying to hold on to a trade, and I talk about this a lot in presentations and stuff, um, it's all very well, moving your stops up and moving your stops up and saying, right, okay, trail the stop up and have it right up under here, and and all that. But in the main, if you trail your stops up, normally you end up getting stopped out, so you never get to your targets. So I tend to um, um, let my once I've got into a trade, I don't trail my stops up. I will leave them down to give the trade room to breathe, because trades and markets do larger retracements. Let's take this high here. So if we take from this high here, so if I was I don't know, trailing my stops up, or as soon as I see it start coming down to saying, right, that's it, I've had enough now, I'm bailing out, I'm going to lock in my gains because maybe I've been in from down here, it still ends up a nicely profitable trade, but it doesn't, you miss out on those gains that then come further in. So it depends on what you're trying to achieve with your trading. I'm a target based trader, so I will hold for my targets. And if I trail stops, then I'm less likely to get to my targets, because it's likely the more I trail a stop, it's more likely I will get what I ask for, which is to get trailing stopped out. So I will move my stops up into profit, but they'll still be quite a long way away from the highs up here. So I got trading stopped, in the well, a couple of levels actually. There was a couple of levels. One was at 109.40, but the other one was down. Oh, blimey, 107, 107.25. So it gave back plenty of open profit. But I don't mind that. Um, that's part and parcel of trying to hold on for larger targets or higher targets. You've got to allow a market to put these larger retracements in, like this one here. If you don't, then you're never going to get to your targets. One of my traders, actually, he's been long the euro dollar from down here when we were looking at it in my community and getting long, and he just held on. He's still long euro dollar, I believe. He's out of the country at the moment, so he's away for a month or so. But so he's just sat through you know, the nice runs, this pullback here, this nice run here, and this pullback here, because he's got a different view again to what he wants to achieve with the euro. If he starts saying, "Oh, I don't like this pullback on the euro now. It's probably going to come back to 105 down here," and which it may well do, but he has to stay true to his plan. And that's the name of the game. Whatever your plan is, you've got to try and stay true to it. And so if you start allowing the market to jump you out, at times it might be the right thing. I could see at the time plenty of reasons why the euro might top out. There was some divergences going on and it was making marginal new highs. But sometimes a market will be making marginal new highs and then it just keeps going higher. And it breaks out of that pattern and it just then off it goes. And so sometimes if you've got a piece of analysis, you just got to stay with it, and not try and always be right. And that's the thing. People don't want to make that sacrifice. And I get that, of allowing a trade to roll back too deep when they've seen their open profits. And this is why I openly talk about the amounts that say, oh, look, I was up over 80,000 and it's come all the way back, really, to nothing in relative terms, not a lot. And because I like to shock people a little bit, because people are like, oh my God, I never would have allowed that. Yeah, I know. And that's the whole point. But if I didn't allow for the retracements, then that 80,000 trade would never become 100 or 120 or 150,000 trade. So I can't trail my stops up too aggressively, because then I would always be getting choked out of my trades. So anyway, that's that. Yeah, I mean, the those types of targets, or staying for those targets, is tough. But trading isn't easy, and it's not supposed to be. And so um, that's when the market challenges you, when it does do those things and it goes up. on a nice run and doesn't quite get to your target and rolls back. Yes, if you've trailed your stop up aggressively, then yes, you're all right. But if you, like I said, the trade-off is if you're always trailing your stop up aggressively, then it's very, very, very rare that you ever get to your target because small pullbacks and you're going to get stopped out. What advice would you give a 17-year-old beginner trader? Oh, blimey. I don't know. Uh, have a long-term horizon, first of all. If you're a beginner trader, don't become a day trader. That's probably what you're trying to do, but please don't do it. The odds are higher, more highly stacked against you if you go to day trading. You can make just as much money swing trading than day trading. It's a myth. People think they've got to become full-time traders and day traders, and they'll make more money that way. It's not true. So, and and for most people who have been, who are new like yourself, then the risks of being a day trader are much higher because of the emotions involved with day trading. By all means, trade off of, you know, hourly charts and above, hourly charts, 2 hour, 4 hour charts. So it's a nice semi swing sort of time frame. But the main point is you're not sitting there glued to a 1 minute chart watching the charts going up and down. And so that's where um, it becomes a lot more difficult because the emotions get involved. So that would be my main advice. Don't day trade. Um, oh, Carl, you've finally come to the answer. Right. Just coming, making sure I'm not missing any questions. Oh no, hold on a second. There's another one before. Hashem, should we wait for the Eurodollar to go down to yellow band on your chart here? Uh, then we think buy side. To the yellow moving average, that's not a bad zone actually, Hashem. If it comes down to there, that's the 200-day moving average. It will also be probably in line with these lows here as well. So around the 105-ish area is not going to be a bad zone if it gets down there. Yeah. Carl, you've been trading it for a year, but improving it through the year. Profitable in 2 quarters, but I still hesitated, as shown in your journal last quarter. So haven't fully taken 30 trades without hesitation. Okay. Um, how long shall I give it to actually see if it doesn't work? You definitely need to give it a year. Yeah, definitely a year. What do you think of the S&P 500 is a question here. You were looking for 3,200 target. 3,200, right, okay. Thereabouts, but seems like upside is more probable. Thinking of what that means for the overall market since we're still in relatively bearish environment. See, it's quite interesting, isn't it, that Sodesh is saying that we're in a bearish environment. And I'm thinking, well, the stock market's up 9% this year, the Nasdaq's up 30%, and yet people are saying we're in a bearish environment. I think I know what you mean. That I was saying this earlier on, probably before you came on, logged on, Sodesh, that um, the the macro environment feels like, the central banks are trying to slow the economies and push the economies, nudge them into probably they would prefer like a shallow recession to help bring inflation down. So so yes, they are. But you were looking at a 3,200. I'm not bearish on the stock markets. So I was saying earlier on, Sodesh, the problem is that so many retail traders are bearish all the time that the masses are bearish, yourself included. I'd rather be on the opposite side. No disrespect. So it's not that the markets can't come down, but when there's an extreme of retail traders, I was talking about this earlier on. There's an extreme in retail E-mini futures contracts. They've got their largest net short position on record, and reflecting that bearishness that's out there. So I'm I'm always going to be looking to be on the opposite side of the masses, of the retail masses. It's not that they can't be right at times for periods and whatever, but in the main, I'd always want to look the other way. If they're mass bullish or en masse. See, if they were en masse bullish, I'd be looking for reasons why the market might want to go down, and vice versa. They're not. They're en masse bearish, and so I'm looking for reasons why the market might want to go up. And so I shared those earlier on in tonight's broadcast, but you'll need to go back, watch the recording, and I share some statistics and some probabilities earlier on about that. But it's not to say that the markets couldn't end up falling over if we started to see a deterioration in the US economy, or certainly if the Federal Reserve carry on hiking interest rates, then we would start seeing the stock markets coming down. So but they're not at the moment. Nasdaq's up 30%. S&P, as I just said, is up 9%. Don't get me wrong, the S&P could fall relatively quickly. It's down on the day here today. Um, I think it needs to fall. I said earlier on, below 41 and close below maybe 41.20, somewhere around there. So as a sort of a first heads up, but I can't get massively bearish when the masses are. There you go. Yeah, no, good point. Yeah, you're saying that you've been bearish for a while and you don't want to die by your own bias. Yeah, no, good point there. And so sentiment is always an important part of my trading, is to look at what retail are doing, but also what hedge funds are doing as well. So sentiment's important to me. So uh, if you are bearish, there's nothing wrong with having a view, but maybe if the S&P actually starts going down, and I'm not talking about just today, I'm talking about if it starts rolling over. At the moment, looking at this chart, what is it doing? Overall, it's making higher highs. It's been making higher highs. So it's a bit sloppy, I agree, but it is making new highs. Now, if it starts rolling over, there'll be plenty of opportunity to short it, if it starts rolling over. But realistically, it needs to be back down, 4,100 as a minimum. Really, that's the last low here, just a bit above 4,100 as a minimum. Below that, just to get it going on the downside. So um, I think it's too early to really say too much at this stage, other than, yeah, maybe if it gets below 4,100, then start looking at it a bit more seriously in that manner. Um, at the moment, they're doing okay. Now I've said that, they'll probably come crashing down on Friday. We'll go get a red hot jobs report on Friday, and then the stock markets will sell off, because that'll swing the market into thinking that the Fed will be forced to hike interest rates, and then that'll bring the stock markets down. So yeah, watch out for that on Friday. Kyle, I keep my ear pressed to the ground. I do spend time on the Twitter sphere, scouring around for various pieces of information to pick up on sentiment. So I'm picking up, I want to see not just the main publications, Reuters, Bloomberg. If I see them having um, headline articles which are bullish or bearish, then so let's say at the moment, Bloomberg, a lot of articles at the moment relatively bearish the market. Well, if I saw a Bloomberg Newsweek article talking about how the stock market's going to go down, then I would see that as a bullish sign. So so yeah, I'm scouring around the Twitter sphere. I'll look at retail positioning just on the usual sort of free sites that are available, but I am looking around for other reports as well. I do look at the COT analysis as well to see what the hedge funds are doing. But I scour around for information to pick up uh, on market sentiment. So it's sort of roll your sleeves up, and just look around. That's what I do. What do you think of prop firms with unlimited time? Unlimited time. I don't know what you mean there, Denny. You'd have to rephrase that. Prop firms with unlimited time. I don't know what that means. If there's a downfall from stocks if there is a downfall from stocks, the other day they spike up. Sometimes bad news is good news for stocks. Yes, yeah, we we have seen quite a lot of that, whereby bad news is good news, and the reason we've seen that is that the stock market has been cheering when there's been bad economic data releases, because if we get slightly worse data, not too bad, but slightly worse data, then it means that the market's obsessed with the Federal Reserve and when they're going to stop hiking interest rates. If we get slightly worse economic data releases, then the odds start to improve that maybe they don't have to hike interest rates anymore. And that then pushes the stock markets up. So, yeah, in that environment, bad news becomes good news. And the stock markets go up when there's bad news, bad data comes out, because the stock markets are cheering it, or investors are cheering it, because they're thinking, phew, maybe interest rates won't go up anymore. Oh, Carl, no, I don't believe in 100% mechanical trading. I know you are doing some yourself, but I use strategies which have rules and everything else, but I don't just mechanically trade them blindly. I trade them in line, and I trade in line with a top-down approach, multiple time frames, intermarket analysis, seeing what if I'm trading the dollar, what's the stock market's doing, what's the bond market doing, what's gold and silver doing, what's oil doing. So intermarket analysis as well. Um, Before then using an entry technique, one of my entry techniques. So and sentiment, I think I just said as well. So yeah, no, I'm bringing it all together. So I don't want to trade mechanically like that. I have strategies that you can trade mechanically, but personally, I prefer to trade them um, with other factors as well, with the other analysis as well. uh, that you can have unlimited time to pass the phases. Oh, you're talking about these funded accounts, I think is what you're talking about, Denny. Um, oh, yeah, I think that's what you mean. The funded accounts. What do I think of them? I think those ones are better. Yes, if it's an unlimited amount of time. Do I think that they're good overall? I think no, not really. It's just good business for them. You're just giving them your money. Give them your money. It's just good business for them, with the promise that you're going to end up with 50,000 to trade or 100,000 to trade. Most of them, it ends up just being good business for them. So that's how a lot of them are making their money. They're not making their money through having lots of people trading real accounts. So that's why I have all these rules. Well, they have to have rules, but yeah, in the main, most people will add it, fail, but they keep collecting their fees and application fees. Yeah, see, you're sold on that, aren't you, Denny? It's not a win-win situation. You don't see it, do you? They give you a load of rules, risk, and all of that. So you have to then adjust your trading style to make sure that you don't have a drawdown of greater than, let's say, 5%. Yeah. Um, and so some of them, no greater than a 5% drawdown, and you're then looking to make 5 or 10% or whatever. Sounds quite straightforward, but it actually is quite restrictive and not that easy to continue to do. So it's not a win-win situation. Theirs is a business. They're using you to make money, and I'm not talking about you, I'm talking about the people that do it, are feeding their business. Fair enough. But just see it as that. Don't see it that they're out there to look after you, and that you're going to get given 100,000 or 250,000. Most of them are demo accounts, or they're highly margined accounts. So let's say you get 100,000 account, they'll physically, some of them will be using a broker, fine, and there'll be a highly margined account. So they'll have just, you've got control of 100,000. They might only have a few thousand actually physically in that account. So again, that's why they don't want you to have too big a drawdown. And so you'll see if you pass and see how you get on. Come back to me in 2 years' time, and you'll say, "Do you know what, Charlie, you were right. I wasted my time, and I'd have been better off putting my money into my own account and growing it over time." Just saying. So, um, uh, sorry, Sodesh, I've missed your point there. Oh, I see, Kyle. 5 minute mechanical entry, but yeah, I see. No, so that wouldn't be entirely mechanical. So that's good. I like that, Carl. So you've got a bit of discretion involved with that as well. Yeah. Um, I disagree, Sodesh. Respectfully, it's the same if you trade with a broker. Most will lose regardless. Yeah, that's a good point. That is a good point. But um, my point is that if even if you're decent, you could still end up failing with one of these entities because of the restrictions. You don't have these drawdown restrictions when you're just trading your own account. So you could be a good trader and it still be very, very difficult to trade with one of these funded accounts because of the restrictions that they place on you. When you're trading on your own account, um, it doesn't matter if you have a 5% drawdown, and in fact, it's perfectly normal to have drawdowns. So because of that, you're not going to get booted off of your own account just because you've had a 6% drawdown, and that's what I mean by that. Do you ever go against the trend, and when do you think retail sentiment data is manipulated? Oh, good question. Just put that over there out of the way. A lot of questions coming through. Sorry, I'll come back to that, JP. Definitely agree now, Sodash. It's a way more restrictive in the end. It's obviously better to trade your own capital, but it's a good option to leverage prop firms at the start. See, this is where I disagree. No, it's not, because you're just giving them money and wasting your time, because you won't be able to make the money, is what I'm saying. It's difficult to make the money, but with all the effort and time you're spending, you might as well put that time and effort into your own account. That's what I'm saying. Um, I'm not saying you can't make money with it, but the restrictions will end up outweighing the benefits. So it's not going to be as beneficial as you think. You might as well trade your own money. That's my view. I know what goes on. I was on a phone call to one of the brokers who facilitates many of these funded account programs. They're a broker in Australia, and they are one of the big brokers. They are the biggest broker behind some of the biggest funded account programs which don't use demo accounts. And she said, and she said to me, yes, it's just great business for us. That's it, with a smile on her face. I don't need to hear anything more than that. it's a sucker's. I'm sorry, but I'll say this very, very. I only say this because because I care really. People are getting sucked into it. Like she even admitted on the phone to me, within the next couple of years, the regulators are going to be all over this because people are spending so much money taking up these challenges. Some of them are better than others, admittedly, but the regulators are going to have to come down on it because basically it's just one great big business deal for those businesses. And people are just seeing it like, oh, it's amazing, it's brilliant, and it's when it's not. So anyway, yeah. Um, Approaching it like a lottery, yeah. Right now, I've got to go back and see. Yeah, people do. Yeah, you're right, Carl. Right. Do you ever go against the trend, JP? And when? Do you think retail sentiment data is manipulated? Also, some comment on crude oil if you can. Um, uh, yeah, right. Do you ever go against the trend? Yes. Um, and when? Well, it depends on your definition of a trend because I'm using multiple time frame analysis. Um, what have we got here? Okay. um, let's take the euro dollar at the moment. Um, the daily chart is in a downwards trend. Um, the weekly chart, we could argue, has overall been in an upwards trend since it bottomed down here back in September of last year. So to just use a crude example, um, I will use time frames, and there's an old saying: you fade the short term trend in favor of the longer term trend. So basically, buying pullbacks, a lot of the time, you are going against the pullback, of course. But if you're seeing it as a pullback within a larger trend, then that's exactly what you want to be doing, is buying the pullback. So um, but it's still counter trend to that pullback. At the moment, this euro dollar, that is absolutely, in a downwards trend. So I say absolutely, but over this time frame, it's in a downwards trend. But we don't know yet whether this ends up bottoming out and in a few months' time ends up going higher, because it's not out and out counter trend. Now back here into last year, this definitely was counter trend back down here. But that was one of the, I was trading, and it took me until here to catch it right. So it was several a good few weeks after the low, but that was still counter trend, counter to the prevailing trend. But actually, it ended up being a really good. It was my biggest, most profitable trade of the year, in fact. That one there. The irony, and yeah, I'd had some really nice trades on the short side. So yes, I will trade counter trend, but a lot of the time it's just counter to the trend on that time frame, but it's still within a bigger overall trend. So I'm just basically buying a pullback. But that time, yeah, sometimes when a market is making lows like the euro dollar was down here last year, um, the sentiment gets to such an extreme that you got to be looking for reversals. And that's what was happening down here. Bloomberg Business Week, and I might still have the article. Let's see if I've still got it on my. I kept it for ages, but I don't know. Oh, there it is. Yeah. So it was correspondingly. This is the dollar index now. So the dollar index was right up here, and this was the article that came out just before that high. Bloomberg, can't stop, won't stop. The Fed has turned the US dollar into a wrecking ball and there's no end in sight of the carnage. That came out around late September, or it might have been in just after. It might have been just after the high because no one knows at that point that that's the high. And so when you see articles like that coming out from a sentiment perspective, I've got to start looking. Crikey, they're talking about how the dollar's going to carry on going and all of that. So going back to the euro dollar at that point down here, I've got to start looking the other way when we're seeing extremes in sentiment. That was just one part of that, but it was a great example. And so yes, for that reason, or one that amongst many other reasons, there was a lot of bearish sentiment out there, but there were technical. We were into technical, long-term support zones down here, and so yeah, I certainly did have to look at the long side. So that was out and out going against the trend. Do you think retail sentiment trade data is manipulated sometimes? I don't know. I think you mean from the brokers there. I, I think probably some brokers, yes, yes. Brokers who are based out of the UK or any major financial jurisdiction that has good governance, good regulation, then I don't think that those brokers would be able to get away with it. But I do see some anomalies from brokers who will say, yes, 80% of our traders are short on a given market. And you think, really? That doesn't really make sense. So maybe there is some manipulation going on. But so I always take a view, and I'll look across a range of brokers for if I'm looking at purely retail sentiment data. Some comment on crude oil, if you can. Okay. Um, well, I thought that oil had probably bottomed out over here. From a fundamental perspective, OPEC don't really want to see oil prices going lower, do they? But at the moment, oil is struggling again here on the daily chart. On the weekly chart, though, on the weekly time frame, you get a slightly different perspective. That this is my 200-week moving average here, and we've got this divergent behavior going on here. I've just got a straightforward MACD indicator down the bottom, and it's been diverging here. So in the bigger time frame, I'd like to see oil work its way back up a bit, but certainly in the short term, it's still weak. But I would actually quite like to see it bounce and bounce back to sort of towards 80. But it's not what it's doing at the moment. So I'm not in it. I have no bias in it at all. I'm just saying what I would like to see from just looking at the charts there. Right. Uh, right, Michael, on the S&P monthly chart, there's a nice trend line going from the highs of April 21 to January 23. Oops, Feb 23. That must be it. Don't know. Oh, okay. I think maybe what you mean is it's broken out of that trend line and then retested it, Michael. Maybe that's what you're. Uh, maybe that's what you mean. Um, uh, yeah. Okay, Michael. Sorry, I just seen your comment there. So now I can come to a weekly chart. Yes, it's clearer actually on the weekly time frame there, Michael. That you've just said there. So yeah, it's nice. I had this one here, which had already broken out of and brought back to, but similar sort of thing on that you've just alluded to there. So yeah, absolutely. Yeah. Get rid of the. Oops. Get rid of those for now. What time frame do you day trade? Day trade on? Prosper, I don't day trade. I used to day trade, and I used to predominantly trade off of or execute off a 5 minute chart when I did used to do it, but I don't day trade. It's very rare that I'll day trade. Now and again, like twice twice a year, but yeah, I don't really day trade. I was saying earlier on, you can make just as much money from swing trading as day trading, so it enables me to be here like this tonight and just have a chat without thinking, oh, I might be missing some moves. So I'm running CBT, Charlie Burton Trading. I'm doing lots of sessions in my trading room, but they're training sessions, and we will execute and take trades during some of those sessions. But they're swing trades. They're not in the main. They're not day trades when I'm trading. So it enables me to, it's amazing running CBT that, the amount of calls that I have to make in between running trading sessions. And so I wouldn't have the time to do it. But I'll be brutally honest as well. I don't have the inclination either. I've done all that in my past. I find swing trading from a time allocation perspective um, is much more suited, and I'm not glued to the screen in the same way. Although I am sat here a lot, I'm not sat here having to glued to a 5 minute chart going up and down. So it's easier all round in that regard. Do you think it's impossible to be consistent in trading by putting limit orders because you work 8 hours a day? Yes, that means I cannot monitor the trades. Yes, absolutely. That's swing trading, Denny. You don't need to be there around to monitor trades when you're swing trading. So yes, you can place orders and let your orders get filled or not get filled. That's swing trading, and so of course, um, more people are profitable swing trading than those who day trade. That's just the way it is. Don't get me wrong. There are plenty who are profitable with day trading, but as I said earlier on, the problem with day trading, especially for people who have been trading less than 2 years, is that they don't have the mental resilience to um, the rapid moves that can happen intraday, and being able to deal with wins, losses, revenge and not revenge trade, and all those things that you can end up doing and are susceptible to with intraday trading. So for that reason, day trading for newer traders is a lot tougher. So, and I always say, look, you don't have to do it. Trade off of hourly charts, 2 hour charts, 4 hour charts. You only got to hold trades for probably a few days, sometimes less than that if it's off an hourly chart. But you're not then at the mercy of looking at a 1 minute chart going up and down, and then you're more susceptible to being lured into bad trades. So and you can be just as profitable. It's a myth. People have this assumption that day trading is going to be more profitable, and it's not. Okay, I think we got the end of the questions there. Are there any more questions here? We've been running for wow, an hour and a half here. So let's just um, let's just see. Uh, Sizing up brings me extreme fear. Been trading 3 years and profitable for 1.5. That's great. Well done, Remo. Congratulations to you. Intraday trading only using systematic edge. It's like I'm ghosting my potential to make full time. Okay, sizing up. So sizing up is a problem for you. Yeah. Um, yeah, it's interesting that you've been, profitable for a year and a half now, and yet you're still scared, as you say, of increasing your position size. So a lack that says still that you have a lack of confidence in your setup, even though, as you're saying there, you've been profitable for quite some time. So I guess you need to delve into why you are still not confident. Is it that you're not confident that your setup will stop working once you actually increase your size? Maybe that's what you're scared of. Um, but there's only one way to find out, and so you've got to use some self language to say, well, look, I've been successful with this for a year and a half, and changing my size won't make any difference to the trading style that you're using. And so yeah, why is there that underlying fear? How can you increase your confidence? So then that comes to other other techniques to try and increase your confidence. And so you almost need to say, I can't afford to not size up. That's why I can't afford to not do that. And really, though, you have to take the plunge. If you've been successful for a year and a half, it's a decent amount of time. Um, it's not a guarantee, because there are no guarantees that a year and a half is a decent amount of time, but it's not a long period of time. But because systematic strategies do fail, as you probably know, over a period of time. So, but not all of them do. And so you have to take the plunge. And what I would suggest is to increase your position size by a smaller amount. Don't just double it overnight. So if you're currently trading at, I don't know, one lot, go to 1.1 lot next, 1.2, 1.3. Gradually increase your position size rather than just doubling it or trebling it or whatever, because that can bring in a lot of fear. So increase the position size gradually would probably be a good way to go about doing that, approaching that. Thanks, Harry. Charlie, what do you think about realistic trading targets? I've heard about guys who aim for 10% a year, and it just doesn't make sense to dedicate that much time and effort um, to not even be able to beat the S&P if I was investing long term. Yeah, it's a good point. Having said that, on a risk adjusted basis, some of those guys may well be far outperforming the S&P, even if they are only doing 10% a year, because you've got to look at what their risk adjusted returns are. So just having your money sat there in the S&P, you're at the mercy of the markets. Then you're at the mercy of bear markets. Just look at last year. So yes, long term as an investment thing, but a lot of traders, myself included, like to have that control of managing our own money, and feel that I feel I have way more control than if I just put my money into the stock market, for example. So, what was the question? Um, and 10% in a year, it's all relative, isn't it? If you're trading with £1,000 in your trading account, 10% a year is not going to be very attractive to you. Even if you've got £10,000 in an account, not going to be very attractive to you. If you're trading with £1 million in a trading account, 10% in a year does become more attractive. So again, it's all relative to how much you're trading with as well. But I agree that uh, the smaller the accounts, then people want the bigger returns. So yeah, totally agree on that. What do I think are realistic trading targets? I've always said I do think that it's achievable to make 50% in a year. One of my traders, he had over the last 5 years, he's made uh, 80%, 82%, 50%, not in this order, 33%, and I can't remember what the other one was. So maybe there was two 50s in there. There was a 33, and there was two 80s. Maybe there was something another one under 50. So that was in his last 5 years worth of performance. So they vary from year to year. You wouldn't expect to make 50% every year or 80% every year, but it's achievable. And so I've always said that, I think 50% in a year is achievable as a trader. You might be you go and make 150% or 250%, depending on what you're doing. It might go and be that you make 20% or 15. It varies depending on your strategy, what markets you're trading, what the markets are doing in a given year as well. So, um, but I do think that that sort of figure is achievable. Do I think you would make 50% every year? No, I don't. I don't make 50% every year. But as a rough ballpark figure, then yes, you could overshoot it, but also assume that therefore you could undershoot that as well. But I think it's achievable. Yeah. Um, Uh, so unfortunately, most of the industry is more focused on the monetary aspect, and that results in mediocre results. Um, yeah, I think that trading, too much of trading performance, people get into trading. I always say this: get into trading because they want to make money. We all do. That's why we trade. That's the ultimate end goal. But really, where we should be spending most of our time is on the process of trading, on the process of trying to be the best trader that we can be. If we spend more of our time on that rather than on thinking about how much money we want to make, if we're thinking about how much money we're making, oh God, I haven't made my 5% a month yet this month, then our focus is coming away from the process of being the best trader we can be. So we need to flip it upside down, really, and that's what I do. I don't even look at my P&L a lot of the time, as anyone who's been around for a long time knows, because I've said this many times before. Um, so the process of trading is where your attention should be. Journaling, reviewing your journal. Don't measure your success or non-success based on your P&L. That's nonsense. Your P&L may be 0% for a month, for a quarter, let's say, and you might then say, "Oh, this is terrible," and actually, you've done nothing wrong in that month or in that quarter. And actually, you review all your trades and say, "Actually, I've executed everything flawlessly. I've done nothing wrong." And in the following month or the following quarter, you're doing exactly the same things, and then you're going to have a stonkingly good period there. So the if you if you measure your success by your P&L, then you're going down the wrong path. You measure your success by how are you doing? Are you sticking to your trading plan? Like my trading plan, as I talked about earlier on in that example on the euro, um, I stuck to my trading plan. I'm not jumping out of my trading plan. People start doing that, and then they're all over the place. So that's the best approach to have. To always think about, are you doing the right things? Sticking with your trading plan, not jumping out of trades, not jumping into trades, not outside of your trading plan. Um, Reviewing your trades, your journal, and all of those things. That's the business end. And if you get the business end right, then the profits will ultimately take care of themselves. It still doesn't guarantee that you're going to be making money every whatever period that you're looking to make money over, but you're still going to have drawdown periods and losing periods or whatever. Um, but we can't control those. Those are a natural byproduct of trading. What we can control is what we do, and our approach on a day-to-day, week-to-week, month-to-month basis. Okay, right. I think we'll call it a wrap there. We've been going for an hour and 3/4. This is what happens. I don't do these that often, and we end up sitting here for 2 hours or more. We're getting closer towards 2 hours right now. I'll just see any of the last couple of questions that come through, and then we'll call it a wrap. Um, for childhood beliefs, is going to a performance coach or a therapist a better move? Sorry, Remo, I don't know what you mean. What do you mean for childhood beliefs? What does that mean? I'm sorry, I don't know what you mean there, Remo. Um, uh, please rephrase. I don't know what you mean. Oh, limiting beliefs in trading. Oh, from childhood. Oh, I see. Um, yes, yes. There's plenty of therapists out there that could probably help you with that. Yes. Um, yeah. I think that is a good thing. Your question is it a good thing? Is it good to um, is it a better move to go and see some form of therapist about that? Yes, because it will indirectly help you with your trading. I know a good therapist who's dealt with a lot of traders, worked with a lot of traders. His name is Keith Tunstall. Look him up. He's online. So um, no, thanks for your input there, guys. There, thank you, Sodesh. Thank you, guys, for your inputs and your questions there, and your statements as well. Um, you have my comment. If you go back up, green. Oh, JP, sorry, I must have missed it. My apologies. Let's go back up. JP, where? Oh, the only one I've got from you, JP. Oh, blimey, I can't. Was the one where you said, "Do you ever trade against the trend?" That one. Is that the one? JP, is that the one? Thanks, Remo. No? Oh, there's another one. Right. I can't see a comment. I do not have another comment from you there, JP. You'll have to retype it in. I don't have. I've scrolled right up. The only comment I've got from you was the one about, do you ever trade against the trend? Do you think retail sentiment data is manipulated? So I cannot see. Nope. Another comment from you. So please retype it. Yeah, I'll wait for that one. Thanks, Davey. Yeah, I always say I'll try and do one. I think once a month's too regular. About once every 6 weeks or so is about right. I don't know when the last one was. Let's have a look on the YouTube channel here, see if I can see when the last one was. It says it was 2 months ago. It doesn't give me the exact date then. So yeah, okay. The short videos about psychology, yeah, they're my favorite, Denny. Yeah. A lot of videos that I do are as a result of questions that come through on videos. So, yeah, which, is good because it gives me content to go and put out, So, hurry up, JP. Quickly write your comment. I'm waiting for you here. Do I have a scalp? Nope. As I said, I don't day trade. So, um, Remo, I'll type it down for you. BWRT is the therapy that he does. So there you go. You should be able to find him. He's on LinkedIn and places like that. The quotes like "I can't afford" really have helped me a lot. Yes, Denny. Yes. Oh, that's good to hear. It's a great lot. It's I should have trademarked that quote because it's one of my. It's, I didn't get it from anywhere. It was my own, and so yeah, I like that quote. I'm going to be biased though, aren't I? So Ryan, coming back to you. No, I don't scalp because I don't day trade. So yeah. I mean, I do have day traders within my community. Just because I don't do it anymore doesn't mean to say that we don't have day traders in our community. One of my traders is an ex-bond trader. He's been trading 33 years, been trading longer than I have, and he's in my trading room every day. He doesn't need to be there, but again, he enjoys being there as part of the community, and he delivers sessions as well. So although I do the majority of sessions in the trading room, he delivers sessions regularly. As well, once a week or so, then he'll do a session, and it's a masterclass listening to him talk. So, and he swing trades, but he does day trade as well. And do you know what, folks? This is a master trader, and a master intraday trader at that, and he risks a tiny percentage per trade, like 0.1 of a percent. And yet we see people out there trading, intraday, risking 2% on their accounts and stuff, with all this volatility on their accounts. And so yeah, by all means intraday trade, but you should have smaller risk on your intraday trading than on your swing trading, because by default there's you've got a higher frequency. So if you've got a higher frequency of trades, you can still go and have, you know the stats suggest that if a higher frequency of trades, then you are going to go and have 5 losers in a row, 10 losers in a row at sometimes. And if that's happening intraday, you could go and have 10 losers in a row intraday. If you're risking 1% per trade, 10% loss in a day, it's a bit rich, isn't it? So reduce the risk on your intraday trading. I still haven't seen a comment. Why is it not coming through, JP? Have you copied and pasted it or something? I've just seen your comment saying, if you don't see it again, then never mind. But there's still nothing else. Above your comment there, 849 is Remo. Remo again, then JP. Oh, then you again saying, do you see my question now? And above that, I've typed in BWRT, Keith Tunstall. There's no other question from you. The last thing from you was then at 8:46 saying just a sec. And below that was Davey, Denny, Ryan, Remo, Denny. So weird. There you go. Denny can't see your question either. Don't know what. Where are you posting it? Just type it. Just type it in quickly. Just type it in. It can't be that long a question. Just type it in. Unless maybe that was it. Maybe it was too long a question, and that's why it hasn't come in. I don't know what the. I don't know if there is a limit on the number of words. I don't know. Creme brulee, can you apply your trading principles to day trading? Yes, you can. Like I said, Creme, actually, I do have members in my community who do intraday trade. So, yes. Oh, JP, you've got me wondering what that was now. You're saying, oh, well, never mind. Okay, I don't know. None of us can see your questions. How strange. um, Email it in to Sam, and she'll forward it on to me. After how much time or how many trades would you consider a setup to be good, or yourself as consistent, or just on a lucky streak? Whoa. Good question to finish off with, really, here. Um, Again, it depends on your trade frequency. But let's say I had a question from someone else, saying that he had a strategy that traded once a day on a 15-minute chart. So it traded once a day, and he'd back tested it over the last year. So it was like something like 240 trades over a year. And he said, is that enough? And my answer was no, it's not. So it's a lovely number, sample size, but the problem is it's condensed into a 1 year period because of its the time frame that it's trading over. So in any one given year, the market dynamics can be whatever. So a strategy that may work in 1 year on a time frame like that, so it's done a lot of trades, but it might be absolutely useless the following year, and it might have just been pure luck that it worked over that year. So um, the answer to your question is it depends. You can't just say how many trades, and like in that example there. So it depends on the time frame. Um, Basically, on a daily chart, then you well if you were back testing, you would need at least 10 years of data for a daily chart. If you were trading off for something like hourly time frames or 4 hourly time frames, you're still going to really need 4 or 5 years easily, just to make sure that if you just cherry pick it over a year or two, that it might have just been that the market was in a sweet spot for that particular strategy over that year or two. So it does take quite some time. I see a lot of people come to me and say, "Oh, I've got a great strategy. I've been making money for the last 3 months," and then 3 months further down the line, they say, "Oh yeah, the strategy stopped working." So um, the answer is you don't know once you're into a live environment. But if you've got a strategy, then you should be able to back test that strategy. And the further you can go back, then the better, the more robust it could be. Be careful not to overfit it and curve fit it, the strategy, though, because that's something which happens a lot. Curve fitting to the data, because you'll say, "Oh, yeah, it doesn't work over that date. I'll change it around over that period. Oh, and I'll change it back over this." And you end up just constantly curve fitting. So, did I ever consider quitting trading? No. Trading, I've always been very passionate about, and so I've never considered quitting trading. It's been frustrating at times, and so it certainly tests you and tests your resolve. But I would never consider quitting it, because I love the mental stimulus and the mental challenge from trading too much. So no, never considered quitting it. No. I know people quit all of the time, and the reason people quit is because they get into it for the wrong reasons. We all get into trading for the wrong reasons. We get into trading because we want to make money, um, to some degree or another, whether it's on the side from our jobs, or maybe we want to become a full-time trader, whatever. Um, but you've got to fall in love with the art of trading, because if you don't, then when the market does test you, because the market's going to kick you up the bum loads of times. Um, when it does test you, what are you going to do? You're probably going to quit. So you've got to learn to love all aspects of trading, not just the wins. You've got to learn to love the losses as well, because they're going to come, and they're going to come at you, and it's going to test you. So no, I love and I'm passionate about trading. So no, I've never considered quitting. Yeah, Marco. So yeah, it's not enough. So I didn't even know that until I've just seen your comment. But yeah, so 6 or 7 months isn't enough. It might just be that your strategy is in a sweet spot within this. I mean, it's great that it's profitable here, but it's unlikely that it's just going to keep on at that rate. So I don't want to put you off of it, but you've got to stay with it, keep using it. But I'm just being giving you some um, general advice that yeah, your historic data isn't enough to know whether that is actually profitable. No. It might just be that it's in a sweet spot right now, but you want to know, is it still going to be in a sweet spot 6 months from now, a year from now? And you haven't got enough back tested data to actually know that just yet. Okay, right. I'm going to have to go. Because otherwise there'll be more questions coming through. Thank you ever so much for all your questions here tonight. Nice having a little bit of a market chat, which I did more at the beginning. If you came in late, then I did some analysis in the markets and talk through some various stats and probabilities as well. And so I shall leave you to it and see you again in about 6 weeks' time.